I don't know about you, but I found myself craving Oreos the whole time I was doing research
Oh yeah.
on RJR Nabisco. And then I looked up some of the other brands, and I think I ate all of these things when I was a kid, certainly.
Oh yeah. They got Nilla wafers. They got Barnum's animal crackers.
So
Like this
good.
was
Yeah, the
basically our
classics.
childhood. Yeah.
Yeah, Ritz. Yeah, a little bit of everything. And you asked me this earlier. Lifesavers was
Right.
a candy. They're no longer a Nabisco brand, but they were back in the 90s. So, ready?
Let's do it.
Let's dive in. Welcome to the second episode of Season 2 of Backtest, the podcast about defining moments in market history and their timeless lessons. I'm Daniel Gamboa,
I'm Matt Harris.
and we are your hosts.
Before we dive in, a quick reminder that this show is for informational purposes only and it is not investment advice. Daniel and I may have investments in the companies discussed.
On October 19th, 1987, the stock market crashed. Like the rest of the financial world, Johnson tuned in his Quotron and slipped into a state of shock. RJR Nabisco, which had been trading in the mid-60s the week before, plunged into the low 40s by midday. In the crash's wake, the stock languished there for weeks. It was the beginning of Johnson's road to ruin, for the low stock price would haunt him for months to come. In December, the company posted a 25% profit increase, and the street ignored it. Even when food stocks rose that winter, RJR Nabisco remained in the dumps. No matter what Johnson did, buyers treated his stock like a tobacco stock, even though 60% of its sales came from Nabisco and Del Monte. Matt, that's an excerpt from the canonical book about today's topic. The book is called Barbarians at the Gate, The Fall of RJR Nabisco, a very dramatic, very colorful title. Brilliant job of marketing, in my opinion, for what is arguably the most famous leverage buyout of the 80s, and in fact, still to this day, the fifth largest LBO in U.S. history.
Yeah, actually, on an inflation-adjusted basis, RJR Nabisco is the largest private equity deal in history.
Huh.
So this is a truly mammoth deal in the 80s. It was 3 times bigger than the second biggest deal in the 80s, which was Beatrice Companies.
Yep.
So in episode 1 of our 80s on Wall Street series, we told the story of the rise of the high yield market and how it fueled 1980s Wall Street. Today, in episode 2, we're going to tell the story of another financial tool that came of age in the 80s called the leverage buyout, or the LBO, that went on to become a whole asset class in itself. This is really just the beginning of private equity. What was an LBO in the 1980s turns into private equity today, which, just like the high yield market, is a massively impactful and influential market.
Yes, it is. And before we jump into the story, a quick thank you to our presenting partner, EQT Corporation.
At Backtest, we study market cycles because patterns from history rhyme. Whether it's unlocking capital with high yield bonds and private equity or unlocking the energy needed for AI applications, understanding history gives you an edge.
That's right. And the company unlocking energy to power AI is EQT, producing American natural gas to help deliver affordable, reliable energy at scale.
So we're picking up our story of the 80s on Wall Street in January 1987. The markets have actually been great from August 1982 to January 1987. Actually, you're in the middle of one of the greatest bull markets in U.S. history. And the first 8 months of 1987 are just an absolute bonanza to the upside. The stock market goes up another 40% by around mid-year. The markets are being driven higher through the mid-80s by falling rates and falling inflation. In the early 80s, late 70s, early 80s, that's when Paul Volcker raised interest rates super high to try to kill very high inflation, and he was successful. And now we're actually on the other side of that. At the same time, there's a ton of M&A happening at really high prices that we'll touch on a little later. And then the third thing that's really driving the market higher through the mid-80s is this new investment strategy called portfolio insurance. Remember that from 1968 to 1982, this was a super painful time for investors. Most people just pulled their money out of the market and had no intention of returning by the end of this. One of the things that gave investors the confidence to come back to the market was that they thought they could now protect their downside or their losses by buying this thing called portfolio insurance. So the portfolio insurance investment strategy was actually a byproduct of some research published in 1973. This research is actually still very influential today. It was written by these guys named Fisher Black and Myron Scholes, who they actually applied to teach at Hogwarts but were rejected, so they went into finance after that.
They do
With it,
sound like Harry Potter names, don't
yeah,
they?
they're great names for professors at Hogwarts. They wrote this paper called "The Pricing of Options and Corporate Liabilities," where they laid out two things that were and still are really important. One is how to price the option to buy or sell a stock in the future, and the other one is how to replicate the performance of an option to buy or sell a stock in the future using stocks and cash. A couple years later, two different professors at Berkeley took Black and Scholes' ideas and created an investment strategy called portfolio insurance. It was supposed to protect an investor's entire portfolio from losses above 20 to 30% at any given time. So this is like a really compelling pitch that this new investment strategy is making. They're going to investors who are mostly on the sidelines, and they're saying, "We'll manage your money, and it's actually not possible for your portfolio to decline in value more than 20% at any given time, and we'll lock in all the gains along the way." This was really meant to give investors like pension funds confidence that they could just load up on stocks without really being concerned that like a big pension payout will happen at a time when the market's down 50%. Just to give you a sense for how portfolio insurance impacted markets and sent it higher, one study I read showed that pension funds, which are the whales in markets, right? These are the biggest investors along with like sovereign wealth funds. Pension funds that had portfolio insurance had 56% of their portfolio in stocks, while pension funds without portfolio insurance had closer to 40% of their portfolio in stocks, which is like a huge difference when it comes to the pension world. But there's one, really big issue from portfolio insurance, and it's that this is an academic model. It assumed ideal conditions in the market. It's never been tested in the real world. So it assumed things like consistent interest rates, consistent volatility across time, no transaction costs, and that investors would never have an issue with liquidity or with selling and buying as much as they wanted at market prices. So up until mid 1987, the market's on this 5-year tear. You're actually up 2.5 times since 1982, and you're up 40% year to date in the middle of 1987.
What a great year.
I mean, why not, right? If the economy is doing great, if you're a long-term investor who owns portfolio insurance, your downside is protected. And just to give you a sense for the sentiment in America at this time, June 1987 is the month that President Reagan, who had come into office in 1981, he goes to the Berlin Wall and he says, "Mr. Gorbachev, tear down this wall."
So good. What a great speech. He said it a little bit more glamorously, though, I think.
What are you talking about? It was great. He yelled it. So mid 87, things are looking pretty good. But in September 1987, the market starts to cool because the Federal Reserve is starting a moderate rate hiking cycle that took Fed policy rates from 6 to mid 7s. And this is specifically in response to an exceptionally weak US dollar and concerns that it would cause inflation by making imported products more expensive. In mid 1987, the US dollar had fallen almost 40% since 1985.
People think it's bad now, huh?
Yeah. At first, this was actually intentional via something called the Plaza Accord that we'll study in a different series. But in 1987, it was because the US was running its first experiments with the idea that deficits don't matter. And holders of US dollars were selling them because they were worried that deficits do matter and that this would create problems for them later on. And so in response to this, in September, interest rates are going up and the market sells off 3%. But October 1987, things start to get really messy. Remember I said how portfolio insurance's offer was to protect your portfolio from losing more than 20% of its value. Pretty compelling value prop.
Yep.
People loved it. At this point, about $100 billion worth of stocks were covered by portfolio insurance. And the way these strategies worked is they actually sold more as prices fell more. This is kind of the way that they worked.
Is that because they were trying to avoid further losses, basically, for protection?
Yeah. And the computerized sell orders from portfolio insurance started to overwhelm the market on Friday, October 16th, which was up to that point, became the most active trading day in history. And the market was down 10% in the last 3 days of that week, ended October 16th. And the scary part about this was over the weekend, apparently, pretty much everybody knew that these computerized models that are driving sales out of portfolios, everybody knew that they had somehow fallen way behind on their sales.
Hmm.
and that Monday was going to just see this deluge of sell orders.
So basically, you're saying there's a lot more selling pressure than buying pressure, and so there's a backlog of sell orders that are waiting for a bid. Is that kind of how it worked?
Right.
Yeah.
And so we come into Monday, October 19th, 1987. This came to be known as Black Monday. It was the biggest down day in stock market history. The stock market fell 22.6% in a single day.
Brutal.
Over half of that was actually in the last hour of the market being open, as portfolio insurance just put in more and more sell orders and overwhelmed the buyers. And which this just wasn't something that was predicted in the models that were behind all this stuff. And remember, the market was down 18% before Black Monday. So at this point, we're down 40% from the peak.
And Matt, my read on this is that nobody really understands exactly the dynamics that played out that day, right? There are a lot of different competing narratives, and even in the literature, in the academic literature, there's a lot of debate. I think portfolio insurance is the primary driver that everybody built consensus around, but it's still not a well understood dynamic of exactly how it all played out that day, right?
Yeah, you're right. There are well-known economists who have said that we don't actually know exactly what caused this sell-off. All they say is that there was a lot. Basically, there was a lot more. Everybody wanted to sell, nobody wanted to buy.
Yeah,
is pretty
right.
much what everybody agrees on. And then this portfolio insurance thing is something that was specific to this time period, and it doesn't exist anymore in this way, right? Like
Yeah.
portfolio insurance still exists, but now you can just buy a put option. At this time, the put option market was not big enough and liquid enough for a pension fund to use. So they had to use this synthetic option that was selling all these stocks on the way down, and that was how they protected their portfolio.
Crazy.
So on Black Monday, RJR Nabisco stock fell from $71 per share to $34 per share. That's a fall of 52% in a single day. When
Ouch.
your business is doing fine, and actually the economy is doing fine.
Yeah.
Right?
What a great buy-in opportunity. It's on a discount.
Yeah. And the stock just kind of languages there. It never really gets back above $50 per share, which drives the CEO of RJR Nabisco, Ross Johnson, absolutely crazy.
Yeah, well, rightly so. So let's dive into RJR Nabisco and the story that we're going to tell. The 1987 crash is such a critical backdrop to what comes next. And so is Ross Johnson, right? He, I think, is emblematic of a certain type of executive in the 1980s. And these are the successors to the company man that we talked about in part one from the 50s and 60s. If the average executive in the 50s and 60s was a cautious, corporate steward of their company, somebody who intended to stay there for their whole career, decades and decades of work, trying to make the company better and being very loyal and working for a pension in retirement, what replaced that in the 80s was this kind of bolder, more individualistic type focused on shareholder value and really personal status and perks. And that fits Ross Johnson to a T. So his background is pretty modest. He's from Winnipeg, which is like the Canadian version of a Midwestern city. It's a small town in Canada. He's an only child. He's born in 1931. His dad was a hardware salesman, and his mom, Carolyn, was a bookkeeper. Ross comes across as this very smart, extroverted kid who is a lot more interested in relationships and winning the social game than in getting the best grades. He's not particularly great academically. And he hustles. So he has multiple jobs. He's selling magazines and candy to buy clothes, of all things, right? Like serious stuff. He's not just buying frivolous things. And after graduating from college, he works as an accountant. He gets bored. He moves to marketing and sales. He does much better there. He loves to have fun. He develops a reputation for blowing up his expense account. So he's going out and playing golf with clients and, having expensive dinners and drinks. He also develops a reputation for colorful language. So rather than saying that accountants work with numbers that are backward looking, he says stuff like, quote, "An accountant is a man who puts his head in the past and backs his ass into the future," end quote, which I guess is a more fun way to say that. Despite all that colorful language, though, he has a pretty average career up to this point in his life, and he wants more, but he's struggling to get ahead. He works at GE, and he asks them for a transfer from Toronto to the US. He wants to play in the big leagues. They turn him down, so he ends up leaving the company, and that's when he lands at a big Canadian department store called T. Eaton. And he attaches himself to his first mentor, the first key mentor of his career, a guy named Tony Peskett. And it's a perfect match because Tony's mission is to modernize T. Eaton, which is kind of a sleepy company, a very conservative company at this point. And Tony is shaking things up. And Ross picks up something that he's going to carry with him to every other organization that he works at in his career, and will eventually be the key for him, the key playbook for him when he's running RJR Nabisco. So from Tony, he picks up the idea that you constantly have to disrupt things, because the moment something gets established, it starts decaying. This is the Tony philosophy of the corporate world, and Ross picks this up. Ross actually has a more colorful term for disruption, and it rhymes with Schmidt stirring. Schmidt stirring, you can guess what it might be. After T. Eaton, he works at a company called GSW, which is a small maker of appliances, and it's loaded with debt. And Ross comes to hate debt because when you have a lot of debt on your balance sheet, you have to watch your expenses like a hawk in order to operate and survive. And then after 2 decades of kind of muddling along, he lands his first big job. He ends up taking the job of president of the Canadian arm of an American food company called Standard Brands. And the Canadian business unit is a mess. Ross cleans house. He swaps out most of the leadership with younger, kind of work hard, play hard people like him. And it works. And he gets noticed. And eventually in 1973, he's put in charge of Standard's international operations, running it from New York. The problem, though, is that Standard is run by a guy named Henry Weigel, who's the epitome of a Spartan CEO. He's described as a penny-pinching tyrant that would fire people for going home early. Pretty scary guy to work for. He's kind of the opposite of Ross, who loves a good party and hates watching expenses, right? Everyone at Standard, including the board, is so starved of color and fun that when Ross comes in, it's kind of a breath of fresh air. He would take people out drinking after meetings with Henry Weigel to liven them up after a beatdown. And he ends up building close relationships with the board. Ross does. And in fact, he's made a director in 1974. 2 years later, by 76, he's made COO of the company, and he's the heir apparent to become CEO. And of course, Weigel hates this because by now he knows that Ross is a big spender, and he thinks he's going to run the company into the ground if he becomes CEO. So Weigel goes to war with Ross to the point that Weigel starts gathering intel on Ross, who's having some affairs and, doing all kinds of shenanigans late at night and going out drinking. There's a story in the book of Ross getting tailed by a private investigator at some point. Ross ends up building a coalition of other leaders at the company, and all this eventually boils over. And Ross basically calls several board members and he tells them, "Hey, I'm leaving the company. I'm out. I can't take it anymore." And he's playing a game because I'm speculating a bit, but I don't think he intends to leave. Another executive around this same time ends up dying of a heart attack. And all of this comes together on a special session of the board where Weigel and Ross go and make their case to the board as to why they should lead the company. And ultimately, the board appoints Ross CEO and forces Weigel out. And now Ross is in his mid-40s, and he's leading a major company, finally. He goes to town, remaking Standard in his image, changes everything. Salaries for executives double. They lease a corporate jet. They remodel their corporate headquarters. The meetings are fast and loose, whereas before they were very structured and kind of to the point. Now they're full of profanity and they just want to get stuff done and get out of the meeting as soon as possible. Revenues start growing along with expenses, but the company is still performing below industry standards. It's not flailing, but it's definitely not thriving under Ross. And just as he starts to get a little bit bored again in 1981, he gets a call from a guy named Bob Chaberlet, which maybe that's how you pronounce his last name, I'm not sure, the chairman and CEO of Nabisco. And Bob says, "Hey, we should talk about a merger." And this made a lot of sense in terms of product strategy, but it was a big cultural mismatch, to say the least. And Barbarians, the book, they say that, quote, "It was as if the Hells Angels had merged with the Rotary Club," end quote, because Nabisco's culture was kind of a sober, low-key, pretty conservative culture. No one had expense memberships to country clubs. They didn't even have company cars. at Nabisco, but they sure do at Standard under Ross. But Bob, the CEO of Nabisco, really wants to do this deal. They start negotiating. They do the deal. He ends up becoming chairman and CEO of the combined company. And Ross, once again, finds himself in the second role. He's president and COO, and he's kind of the heir apparent to the CEO. And slowly but surely, Ross, again, does the same thing he did at Standard. So he and his, what's called his band of merry men in the book, so all these guys that are following him that are kind of on the leadership team, but they're also work hard, play hard people, they set about evolving the culture of the new combined company to that looser style with a lot more perks. And Ross is a master politician, right? He's ingratiating himself to Bob and the board of directors. He's letting certain things go with Nabisco people so he can bring them back up later to his advantage, right? Like, so he's sort of setting them up. And then 3 years after the merger, Ross actually had managed to fill 21 of the 24 leadership roles with Standard Brands people. So these are people that have followed him around. So by 1984, after winning a war for cookies market share with two other companies, Frito-Lay and Procter & Gamble, which I'm sure a lot of people have heard about, Nabisco ends up naming Ross CEO. This is just in time because he's getting bored again, and he's thinking maybe another big corporation may try to buy them out, or, this is now in the 80s, so LBOs are starting to ramp up. And actually what happens is he ends up getting a call from not another food company, but one of the two major tobacco companies in the US called RJ Reynolds. And RJ Reynolds is actually an old Southern cash machine, and they're trying to buy their way out of being just a tobacco company, because by this point, tobacco companies are on the ropes based on some health issues that we'll talk about in a minute. But their CEO, this guy, J. Tylee Wilson, calls Ross in 1985 and basically pitches him that they need a major acquisition to diversify away from tobacco. And he thinks Nabisco is the cleanest fit with RJ Reynolds. Wilson, I think, has done his homework on Ross because he dangles a carrot for him. He says that, hey, I won't be here forever. Why don't we do this deal? And you're going to get first dibs at replacing me as CEO, which is music to Ross's ear, right? Like, this is exciting. This is the next thing he could go do, this massive company. And so they take this to the board. The RJ Reynolds board initially pushes back because naming the CEO is their job, but the deal gets done anyway. $85 a share via preferred stock, almost $5 billion merger. And it's actually, at this point, the largest merger outside of the oil industry. And Ross muscles in some non-negotiables. So he keeps all the perks that he has established at Nabisco. And they make him president and COO, number two behind Wilson. And then for Ross, it's the Standard Brands movie all over again. He's much better at board politics than Wilson is. And in 1986, the board finds out that Wilson, as CEO, has been funding a secret project to create a smokeless cigarette. And this has been going on for 5 years. He has spent $68 million, and he had kept the annual expense of this project just below the level for board approval. And so the board is livid, right? They're floored. They are very angry with Wilson, and Ross strikes again. Same move. He calls a couple of directors, and he tells them he's thinking about leaving. And ultimately, the board and Wilson agree that they can't lose Ross. He's running the food business. Nobody else at this company knows how to run the food business. And so they actually accelerate Wilson's retirement, and Ross becomes CEO effective January 1st, 1987. And there's one thing that's been bothering Ross most since this merger with RJ Reynolds. After the merger, he had moved to Winston-Salem in North Carolina. That's where RJ has been based for like a century. And it's a small town. It's a bit of an antebellum kind of Southern culture that doesn't really fit Ross at all. The feeling's mutual, actually. The people here don't like him, and he doesn't like the town. So he kind of politics his way around with the board and decides to, as one of his first moves as CEO, he's going to move the headquarters from Winston-Salem to Atlanta. And that lands like a bomb in Winston-Salem. So if people didn't like him there, and now they really don't like him, even though he's not taking all the jobs out, it's just like maybe 100, 200 jobs, out of the headquarters. But it's also a point of pride, right, that this company was headquartered there. So moves the headquarters to Atlanta. And that's when the perks at RJR Nabisco really blow up. So now Ross has full control of the company, moves it to Atlanta. The new headquarters are super luxurious. They even have a candy cart, apparently. Did you read about this? That brings them French bonbons twice a day.
I didn't read about that, but my favorite part of learning about all the perks, this surely wasn't true, but in the movie that got made for Barbarians at the Gate, there was a scene where Ross Johnson is on his jet having a call to another executive that's on his jet having a
Yes.
call, and they zoom out of the planes, and both the jets are just next to each other.
Yeah, instead of flying on the same plane, they each are flying next to each other.
Yeah.
I kind of hope that was true. Yeah, I
I hope
couldn't
it
find
was too.
anything to corroborate that. I looked for it.
Looked quite dangerous. They were very
It
close
kind
to
of
each other.
did. Yeah. Those are fighter pilots flying those things. They have not just bonbons twice a day, but they have club memberships that are paid for by the company. Everybody gets a company car. There's a fleet of 26 of these jets, G4s, and a $12 million private hangar for those jets. And so it's a tremendous, amount of expense and perks that these guys have. They're living the life. And the company's funding all of this. To say that, this is over the top is an understatement. And in a way, we're about to see this, but the LBO boom of the 80s is correlated with this stuff because a lot of the stuff is frivolous, right? And there are people out there, investors in particular, that are going to look down on this later. But Ross's playbook at this point is working great. He's making sure board of directors have perks too. So he's taking care of the constituency that he needs to keep happy. In fact, he's actually personally coordinating anytime they want to use the corporate jets free of charge. The company's paying for it. He's giving them consulting contracts on top of their director pay. He's really taking care of them so he can keep control. And when this guy, Paul Stitched, who was the chairman at the time and someone who himself really liked perks, calls him out because it's become too much, Ross basically forces him to retire from the chairmanship, which really paints a picture of Ross is in control. He's got all the power at RJR Nabisco at this point. Very diplomatically, but forcefully, he removes Stitched and he moves somebody else into the chairman role. Meanwhile, Ross Johnson has also been pretty active selling parts of the combined business. So he sells a small food conglomerate that included KFC, a line of cigars called Winchester, and a few businesses in Canada. And he's using this money from the sales to pay down debt. And he has a line out of his office of bankers pitching ideas to do deals because the company's balance sheet is flush with cash. It's over equitized. They really don't have a lot of debt. And everybody wants him to do an acquisition. Everybody knows that Ross is very active and gets bored. And the reality, though, is Ross is just not interested in building something, right? Like he's not interested in leaving his mark. He's comfortable. He likes the perks. But meanwhile, there is one idea that keeps popping up that everybody's bringing him and keeps surfacing in every conversation, a leverage buyout of RJR Nabisco. And of course it's us, right? Because it's 1987 and we're in the middle of the LBO boom.
Yeah, and before we move on, I think, as you're going through the history of the company, I'm reminded of a quote that I read about R.J. Reynolds, which said, R.J. Reynolds isn't a company, it's a religion, right?
Mm.
People loved this company. The people that worked for it loved it. The people that smoked the cigarettes and cigars that they made loved it. They had a ton of brand loyalty, and it just sounded like it was this fantastic company in this small town in North Carolina that I want to learn more about.
Yeah. It sounds idyllic to have lived there and
really
worked
does
for
sound great.
RJ.
I wonder if they worked with big cigars in their mouth. They probably did.
Probably.
All right, so let's talk about leverage buyouts, otherwise known as LBOs. Many people that have heard of LBOs think of them as just a good way to torture bankers that are interviewing for private equity jobs.
Yep.
LBOs are typically associated with private equity, but actually every time someone puts a mortgage on a house, they're doing an LBO, right? So my guess is that many of you listening have done an LBO in your life. When you put a mortgage on a house, you're effectively buying something that you can't afford with your own money by using a lot of debt. And as almost anyone with a mortgage knows, when you buy a house with a mortgage, it has a huge impact on how you live your life after that. The interest and the debt pay down become your biggest expense. So it's kind of the main thing on your mind when you think about how much you need to earn each month. The features of your mortgage that are different from your friends' mortgages are really important. And you talk about them at dinner, right? Like when are property taxes due? How are those handled? When does it mature? Should you refinance?
Yeah. What's your rate?
What's your rate? And like when is a good time to take on a second mortgage? All that stuff.
Never.
So LBOs are the same as mortgages, except it's a private equity investor buying a company instead of a person buying a house. Otherwise, the mechanics are very similar. And LBOs in the 80s are really just the beginning of the private equity industry. right? So whenever you are out there thinking about a private equity firm, this is where that space started in the 80s. And at this time, it's a small, niche market when a few things started to change in the 80s to really heat this market up. The first thing that changed is actually the 80s were the fourth major wave of M&A in US history. This one was driven by the US companies needing to restructure to compete with Japanese and German companies who are kind of up and coming and taking market share. There was also a need to deal with a massive wave of deregulation in the US that was making a lot of industries way more competitive than they've been in the past. And the third major thing happening driving M&A was there was a need to incorporate a bunch of new technologies like computers into businesses. So actually in the 80s, something between 30 and 50% of Fortune 500 companies restructured in response to these huge macro pressures. The major difference between the M&A in the 1980s and the three previous cycles was that there was a lot more debt used in this M&A boom. And it was mainly the kind of debt financing that had been democratized by Michael Milken, the high yield market that we talked about in episode 1. So M&A activity was just way up in the 80s, and LBOs are a big, new, important part of the M&A world. The second thing that caused LBOs to explode in the 80s was legislation called ERISA.
Mm.
Most books don't cover this because it's like really nerdy and wonky. But if you read the academic literature and do the math, this was a huge deal for the rise of private equity and high yield. If you have dinner with a boomer investment manager, they're going to spend half the time talking about ERISA because it really, this legislation actually pretty much shaped their early careers. So what is ERISA? This is a really important part of the story. So what is ERISA? ERISA stands for the Employee Retirement Income Security Act of 1974. Get excited.
Yeah, ERISA sounds way better.
Yeah. And what ERISA did is it imposed fiduciary duties on pension fund managers. And in the industry, this is called the Prudent Man Rule. And at first, the Prudent Man Rule, when it was passed in 74, it actually made pension fund managers more conservative.
Hmm.
But then in 1979, the Department of Labor clarified the Prudent Man Rule is actually judged at the portfolio level and not at the sort of individual investment level, meaning pension funds could now justify investing in things that were risky as long as they made sense from a portfolio perspective. So now for the first time after this clarification, they can invest in diversified LBO funds, diversified high yield funds, diversified venture capital funds without having to worry about being personal. Like you would never have done it before the clarification because the Prudent Man Rule made you personally liable
Yeah.
for your mistakes, and you're working at a pension fund, so you don't get any upside.
Right. So aggressive. Yeah.
Yeah.
You're getting paid like a normal salary, and yet you're going to be personally liable for an investment that's super volatile and might draw down a substantial amount of the capital base. You're never going to do it unless it's at a portfolio level.
Right. And so it was the ERISA clarification in 1979 of the Prudent Man Rule that allowed the LBO market to scale and for fund sizes to explode. So the only pool of capital that's bigger than pension funds is banks, right? So this is a huge new pool of capital that's available for private equity firms and things like that. And then the last thing that really made the LBO market take off in the 80s was this deal called Gibson greeting cards. An investment firm called Westray Capital bought Gibson greeting cards in January 1982 for $80 million. But Westray actually only put in $1 million of their own money. The rest of the $80 million was debt, right? So they put $79 million of debt on this company, and they only put $1 million of equity. Gibson greeting cards goes public in 1983 for $290 million bucks. Which is so 79 of that was used to pay off the debt, and then 211 million of that was distributed to Westray, so they made 211 times on their investment in 17 months, and this basically rings the dinner bell for all the investors, all the money in the world to say, hey guys, there's a feast over here in the LBO world that just waiting for you to come and kind of do deals like this.
That's wild. There's no financial market in the world that will not boom after something like this happens, assuming that there are more opportunities to go do this again.
Right. And so the LBO market goes from 13 transactions in 1980 at an average purchase price of a little under 100 million, and it's going to go to 47 transactions in 1987 with an average purchase price closer to 500 million, right? So way more deals and way bigger deals kind of through the decade. All right, so imagine you're an investor in the 80s and you want to do an LBO. You pull up a database of all these different companies. You have all their metrics for kind of everything you can imagine. What makes a good target candidate to go explore more? Ideally, the companies that are good LBO candidates are they're stable, non-cyclical businesses because you don't want your revenue oscillating 50 to 100% every year because you have this huge fixed expense now because you took on a ton of debt. Actually, over 50% of the LBOs in the 80s were of companies that made essential consumer goods like food and paper and glass. Really things that you don't buy any less of those things just because the economy's bad, right? So they're very stable, non-cyclical businesses. You're looking at your database and you're also looking for companies that have low capex and R&D because you want as much cash flow as possible to service the huge debt load that you just took on. You're looking for companies that are not that levered today, right? They're not using a bunch of debt today. So you're probably screening just for credit rating at this point when you're looking at your database. RJR Nabisco, for example, had an A rating from rating agencies. They're one of the few companies in the world that had an investment grade rating, which means they're not really aggressively using debt. So you like that. You also want to look for fixable problems to potentially easily unlock a bunch of cash flows. For example, investors viewed RJR as having some fixable problems because their margins were lower than some of their competitors for reasons that they couldn't understand, at least at first. When you're looking at your database, you're like, why are these margins lower? This is something I'm going to go explore. Last thing you'd probably look for an LBO target to go do more work on is just what's their breakup value. The investors want to know they can buy a business and sell off its divisions for more than they paid for it. And so a lot of that is just where is the stock price relative to book value and things like that. So really in a nutshell, leverage buyouts are a way for an investor that recognizes an undervalued company to buy that company and optimize its structure, optimize its operation, and get the rest of the world to realize that, hey, this company's worth a lot more than I bought it for. And then to sell it later on and generate attractive returns for investors and their fund. And similar to high yield bonds, the leveraged buyout becomes another one of the key financial tools that matures in the 1980s on Wall Street. And with that, this is a great time to thank our presenting partner, EQT.
In essence, leverage buyouts are ways to rethink and optimize not just the capital structure of a company, but also its business operations, management's focus, and execution speed. Like high-yield bonds, they widened the menu of options for companies to operate with rigor in the 1980s.
That's right. And operating with rigor to deliver the natural gas to fuel the AI boom is a key focus for EQT. EQT is focused on the infrastructure that makes growth possible, building and modernizing the energy systems that deliver affordable, reliable power where demand is rising.
Which matters because the AI boom isn't just about models and compute. It's about whether data centers and digital infrastructure can actually get the baseload power they need with uptime and efficiency.
That's the unlock EQT focuses on. EQT supplies energy to the infrastructure that bridges breakthrough technology and real-world scale.
To learn more, go to poweredbyeqt.com and be sure to follow them on X and LinkedIn. Big thanks to EQT for helping us bring you the stories of market history and how they apply today. So back to the story. Now that we know what leverage buyouts are, and we know that everybody has been pitching Ross Johnson to do a management buyout of RJR Nabisco, there's a guy, Ira Harris, who is a banker at Lazard. He arranges this golf game with Ross Johnson and the CEO of another food company that you mentioned earlier, Beatrice Foods. And at one point, Ross had looked actually at buying certain assets from Beatrice, but the real purpose of the round of golf was to convince Ross that he should do an LBO. And Ira Harris at Lazard wants to be the banker to help him execute it. So he sets this up, and Beatrice had been taken private by the leading LBO firm, this firm called KKR, and they had installed Don Kelly to run it. So he's the guy that is now playing golf with Ross Johnson. And Ira Harris wants Don Kelly to sell Ross on the idea of an LBO partnering with KKR. But in this golf game, Don basically tells Ross that he would be doing exactly what he's doing now. He can still be CEO of RJR Nabisco, but he would be making a lot more money doing that. Ross already knew this because he had somebody inside the company and other advisors pitching them this and doing analysis. And in fact, he had somebody do analysis on the Beatrice LBO as a comparable transaction. And he had estimated that Don Kelly would make about $400 million from that deal, which, obviously Ross is attracted to that piece. Don tells Ross that he should meet with Henry Kravis, the lead partner at KKR. And by this point, Henry Kravis is already a legend on Wall Street as the lead guy behind a lot of these LBOs that are happening. Ross is still skeptical, though, that an LBO is right for him, but he agrees to dinner with Kravis, apparently because Henry Kravis is a legend and Ross loves nothing more than hobnobbing with famous people. And so he agrees to this dinner, and this is going to be a fateful dinner. Henry Kravis is the polar opposite of Ross Johnson. He's not particularly charismatic in the life of the party sense. He's really intense. He's cool. He's calculating. He's very sharp. I picture him as the scary managing director of every investment banking analyst's worst nightmare. Yep. And also, by the way, the finance guy that you definitely want in your corner. You do not want to be on the other side of the table from him. And to give you a little background on Henry Kravis, his dad is Raymond Kravis, and Raymond had made a decent amount of money in the 1920s. He got wiped out in the crash of 1929, and then he rebuilt a second fortune as a petroleum engineer estimating oil reserves for Wall Street firms out of Tulsa, Oklahoma, which is where Henry grows up. Henry then goes on to work a couple of summers at Goldman Sachs, and after college, he takes the Wall Street route. He works at a place called the Madison Fund, investing in stocks, goes to Columbia Business School in 1967, and then he gets real operating reps running acquisitions in Louisiana for a company called Katy Industries. He's basically going out and buying oil field service businesses and learning how companies work.
He's an oil man.
He's an oil man, yeah. Everything goes back to oil and gas.
I did not know. He came from an oil family, and he got his start in oil field services. But I think, one thing here that jumped out to me was Henry Kravis is really, really a part of a huge trend on Wall Street here. Where I'll read you a couple of sentences from our favorite book, Dangerous Dreamers.
Oh, yes.
Yes, where it says, in the 1970s, 1 in 7 Harvard MBAs became investment bankers, traders, and salesmen. By 1985, the figure had risen to more than 1 in 4, and those with BAs also flocked to Wall Street. And so, you had just a massive change in really the desirability and availability of these Wall Street jobs. Not too long before this we talked about this a little bit on episode 1, but this was kind of a family industry,
right?
And the 70s and 80s, we're going to see a huge wave of MBAs that are not family ties to Wall Street, and it's going to completely change the culture and the makeup of what Wall Street is. And Henry Kravis is kind of right down the middle for what this looks like at this point, having gone to Columbia Business School and being from Tulsa.
Yes, exactly right. And he's going to start rising up here because after another job ends up not panning out for him, he's in between things, and he ends up calling his cousin, George Roberts, for help, just trying to navigate the situation and figure out what to do next. George actually works at an investment bank called Bear Stearns for a guy named Jerome Kohlberg. George loves working at Bear, but he hates living in New York City, and he wants to go back to California. Not that different from Mike Milken, remember, from episode 1. So he pitches Jerome Kohlberg on the idea of working out of the San Francisco office while his cousin Henry replaces him in New York in person with Jerome. And so Henry ends up joining Bear, and these guys are basically doing typical investment banking stuff. They're doing stock underwritings and mergers and acquisitions, but they're also developing the side project that Jerome calls bootstrap deals. And these are riding a trend of retiring post-war business owners who wanted to monetize their business but wanted to retain control. So remaining private doesn't really solve their problem, right? Because it doesn't monetize anything. Going public means you're exposed to the whims of the stock market. You don't really want that as a retiree. But a bootstrap deal allows you to recapitalize the business with debt and allows you to monetize a substantial part of your equity, which, if that sounds familiar, that's a leverage buyout, this is where leverage buyouts kind of come into being, right? There's actually one problem, though, with all of this, which is the head of Bear Stearns, this guy, Cy Lewis, who, by the way, is also a legend on Wall Street. He's the guy that made Bear Stearns into a major firm. He led it for 40 years, from 38 to 78. Needless to say, he's an intense and intimidating guy. He hates these bootstrap deals. He's a trader at heart, and he thinks that if you hold an investment for more than a day or two to realize returns, that's too long. And of course, these leverage buyouts take years to realize. And so Jerome tries to formalize the LBO concept inside of Bear Stearns, and Cy Lewis basically tells him no, which means then Jerome, George, and Henry, who really want to do this full time, decide to leave. They leave Bear Stearns, and this turns into a really nasty fight with Cy and with Bear, but it ends up working out. They leave. They start their own LBO-focused firm, and they call it Kohlberg, Kravis, Roberts, KKR. They started in 1976.
Kind of a pretty big miss there for Bear Stearns. Could have owned KKR.
Yeah, hard to tell in hindsight, but for sure. And what's more interesting still, right, is that they end up raising money from first Henry Kravis's dad, Ray, and from this family called the Hillman family in Pittsburgh. And remember, this is not a big thing. These guys are doing something completely novel, so it's not like people are tripping over themselves to fund them, but the Hillmans actually invest. And this is a really wealthy family. They had made their money in coal and steel before starting to diversify with stuff like this, which, by the way, do you know what else they funded that ends up becoming just as consequential as KKR?
Oh, Drexel?
No, they are actually one of the first major investors in Kleiner Perkins.
Oh, cool.
In 1972, they were one of the first major investors in Kleiner, which is wild, right?
It is wild.
So these guys had major exposure to some of the first, most successful funds in alternative assets, both in VC and PE. So back to KKR, they end up setting the fund economics at 1% of assets under management and 20% of profits, which if you're in private equity today, that's relatively standard. And they're up and running with Kohlberg and Kravis in New York, and then Roberts is in San Francisco. The early years are pretty slow. They have a few deals here and there, but they build a track record that helps them raise another fund, $30 million in 1978. And by 1983, KKR is already on its fourth fund, $1 billion, and they're doing much bigger deals. And they've come to dominate the leverage buyout scene.
Worth noting, though, they went from a $30 million fund one in 78 to $1 billion fund in 83, and that overlaps perfectly with the clarification of the Prudent Man Rule from ERISA, right?
That's right.
The difference is pension funds.
Yes.
So the ERISA is really important, and the way regulations changed and were clarified was really important to this story.
Yeah. So by the mid to late 80s, KKR becomes the go-to firm for leverage buyouts, and they're behind all the biggest deals. So they do Beatrice, which we talked about. It's a $6 billion deal. They do Safeway, the grocery store, $4.5 billion. Another company called Owens, Illinois, $2 billion. And they're really focusing on these big deals because nobody else can compete with them at that size. They're the only ones that can write equity checks big enough and have the track record to go raise the debt to fund these deals. And so nobody can compete with them. But eventually, this is going to be just Henry and George running KKR. Jerome leaves the firm. He doesn't like the big deals. They have some kind of philosophical disagreements over how to do leverage buyouts. And Jerome doesn't really evolve into this go big mentality of the 80s. And then he ends up getting a little sick. Actually, this is all going to end up in a lawsuit at some point in the 90s that they're going to resolve. And it's all pretty secretive. But by the time that Ross Johnson from RJR Nabisco is knocking on the door at Henry Kravis's apartment for dinner in the summer of 87, Jerome is out of KKR, and it's really Henry Kravis and George Roberts running the show. This is a fateful dinner for RJR because they're clearly there to talk about LBOs, right? This is Ross Johnson, Henry Kravis, and now Don Kelly. They're going to talk about LBOs, and specifically, they're going to talk about Ross potentially partnering with Henry and KKR to buy out RJR Nabisco. Apparently, Henry Kravis talks about how great LBOs can be. So he starts the conversation and really starts selling the concept of an LBO, right? How taking on debt makes companies operate more rigorously and how executives can make a ton of money without extra effort. Don backs Henry up. He tells Ross that he has a great working relationship with KKR and they still let him call the shots at Beatrice. But Ross is skeptical of all this. He's not really buying into the idea. He thinks that if someone puts that much money into a company, they're going to monitor it like a hawk, and they're going to make sure that you're doing what they want you to do. And so he actually starts changing the topic in the conversation, and the dinner ends with Henry Kravis thinking RJR Nabisco is probably off the table. They're not going to do an LBO. And KKR doesn't do hostile deals, right? They don't do any deals that don't include the company's management. And in fact, their investors are mostly pension funds, like you said, and insurance companies. And pension funds and insurance companies don't want to be associated with hostile deals. And it makes sense, right? Because a lot of people that have pensions end up getting laid off in these deals. And so Ross leaves Kravis's apartment, and when he gets back to the office the next morning, he has one of his consultants, out of curiosity, rerun the LBO numbers for RJR Nabisco. And he's looking at these numbers, and he just can't get comfortable with the amount of debt that they would have to take on and the expense reduction, and there's no margin of safety. And he's just not interested in that, right? He's not interested in running a business in a Spartan way and focusing on managing his expenses. He might make a lot of money out of an LBO, but he already has money. He has perks. He's really comfortable. But 1987 is going to come hard at him late in the year, and he's going to be really uncomfortable, and that's going to change everything.
Yeah, that's right. As another great 80s and 90s brand, unfortunately owned by a RJR Nabisco competitor, Kraft, would say, oh yeah, it's about to get really uncomfortable for Ross Johnson. So this first meeting between Kravis and Johnson happened in the summer of 1987. Remember earlier that I said the 1987 stock market was on an absolute tear through August. It was up 40% year to date. But then it started to get pretty weak in September, and it proceeded to fall 40%. And included in that, the final day of that major fall was a day where the stock market was down 22.6% in a single day, the worst single day in stock market history, October 19th, 1987, otherwise known as Black Monday. And so like every company on Black Monday, RJR Nabisco's stock fell like a brick. It went from $71 per share to $34 per share in a single day. That's a price to earnings fall of 13.6 to 6.5 for a company that's doing fine and has a really good cash flow profile.
The amount of multiple compression that a company like RJR experienced through this, if you're an LBO investor, you're looking at the market salivating, right? Because it's not a deterioration in the business. It's just a deterioration in the valuation, the price that you're going to have to pay for this.
Yeah. And one of the crazy things about the 87 crash is that, you have stocks like RJR Nabisco falling 60% in a single day, but the company and the economy are fine,
Right?
right? It ends up being totally fine.
Yeah, your revenues are fine,
backdrop.
right? Your revenues are great. Your expenses didn't really change overnight. So literally every single financial characteristic of the business is doing fantastic. It's just the price of your stock fell substantially, right?
Yep. And, through the rest of 87 and in early 88, the broader market's starting to recover a little bit from the crash. And Ross Johnson, he gets, really stirred up about his stock price, which for reasons he can't understand and he just doesn't accept, his stock just hasn't recovered from the 87 crash. It went kind of into the low 40s, and it's just kind of hanging out in the 40s. And the company's doing great. They had a great year in 87. But the market just refuses to treat it as anything but a tobacco company, even though, Ross Johnson views it as a food business. A really important part of the RJR Nabisco story is just to take a second and talk about the tobacco business at the time. In the 80s, everybody thought tobacco companies were going to be sued or regulated into oblivion. In 1964, the Surgeon General released a statement saying smoking causes cancer and heart disease. But the real fear from the market was that tobacco companies had actually known this for a while. They knew that this was really bad for you, but they were selling the product anyway. And so the market was really scared that what had just happened to asbestos companies was going to happen to tobacco companies. Asbestos companies ended up getting sued where they all had insurance, but it didn't nearly cover what was needed because future victims counted as much as present ones, right? So there's this huge unknown. And at least one blue chip company was sued into oblivion. Up until the Surgeon General warning, about 50% of adults smoked. It's kind of wild to imagine. It's gone so far the other way that I was watching Netflix this weekend, and it was for mature audience only, some language and smoking.
Yeah, it's a warning.
Right?
Yeah,
it's a warning on just watching a show. To me, this is the equivalent of I was trying to think about what would be similar for our generation. To me, this would be like seltzer, all of a sudden, causing cancer, right? And in 20 years, you're watching a Netflix show and it says language and sexual references and bubbles. Don't let your kids see the bubbles.
Or social media. There are people using Facebook on this episode.
Right.
Warning.
Right. So the whole market's just concerned that these tobacco companies have this huge unknown liability that is yet to be on their balance sheet through litigation that's in process. And that's how the market is valuing RJR Nabisco. And this makes Ross Johnson just furious because other food businesses, right? He thinks that they're mainly a food business. Other food businesses like Philip Morris are trading at much higher PE multiples. And RJR Nabisco is kind of stuck in the 9 times and lower range. And he really wants that Philip Morris PE multiple. Ross Johnson, he's a deal guy. And there's also a little bit of I'm the CEO of a public company, and the stock price is kind of a life scoreboard situation going on, I think. And he just can't accept that this is the case, and he goes on the offensive to get the market to recognize the value of his company. He considers all kinds of things to get the market to realize what RJR Nabisco is worth. He approaches other food companies like Pillsbury, Quaker Oats, Kraft. That all makes me feel very warm inside to explore JVs and mergers of their food businesses, but nobody wants to do it. He approaches Philips about merging their international cigarette business. And then he also, later, when that doesn't work, he approaches them again about merging their food businesses. Philip Morris owned General Mills, and they're not interested. He also considers creating just a separate class of stocks, one to reflect the food business and one to reflect the tobacco company. He ultimately decides that this is a little too complicated. This is otherwise known as a tracking stock, and tracking stocks became a lot more popular in the 90s than they were here in kind of the mid 80s timeframe.
This is what John Malone would have done, Matt, I think.
Right. Yeah. John Malone would have done the tracking stock.
For sure.
And then, of course, he also considers spinning Reynolds off into a separate company. The 3 bursts of activity that really stood out to me, the first was stock buybacks. Late 87 was actually a really popular time for companies to buy back their stocks because their stocks were so depressed from the crash, but the economy was fine and most of the companies were doing great.
And RJR Nabisco is the perfect candidate for buybacks, right? Flush with cash, not a lot of debt. Go buy back your stock. It's underpriced.
Right. And so the idea behind a stock buyback is that, one of the main things companies do is they make internal capital allocation decisions. How should we spend our cash balance, any money we raise, and the earnings our business is generating? That's like one of the main decisions a company has to make. And there are really only 4 choices at a high level. One is you can invest in growth by, funding internal growth projects or buying other companies. Another is you can pay it out to shareholders as a dividend, where there's something called double taxation to consider. Another is you can do nothing with it, right? You can just let the cash kind of build up on your balance sheet and deal with it, do something with it later when things are more attractive. And the last thing you can do is you can buy back your own stock. So buying back your stock at a price you think is closer to what you think it's worth, it's a great way to quickly get the stock price up. It sends the message to the market that says, "Hey, I run this company. I know a lot more about this business than you know, and this is what I think it's worth, and I'm going to put my money where my mouth is, and I'm going to actually spend it on buying the stock. If it trades below this price, hopefully that means the market response is that, okay, this big investment grade public company that knows a lot more than we do is now buying back the stock, must be worth that." And so RJR announced a buyback of 20 million shares between $53 a share and $58 a share. And they actually did successfully buy back 21 million shares at $53 a share. They spent $1.1 billion on those buybacks. And as soon as they're done, the stock falls back into the 40s.
So brutal.
Yeah. And so Ross Johnson is just kind of losing it. Another way to try to boost your stock price is to launch a major new product. And so remember, the central issue for tobacco companies in the 80s was that tobacco had been discovered to be super unhealthy. And we talked about earlier how the CEO before Ross Johnson, Ty Wilson, he was funding a secret project to develop a smokeless cigarette. Ross Johnson is thinking that this is going to be a major new product. It's called Premier. I actually looked around to see if we could buy a Premier and smoke it on the show, but I couldn't find any.
No chance.
Then we have to put the smoking warning on our show. No kids could watch. He thinks this could be a life raft for the tobacco business. But early consumer feedback on the Premier product comes back extremely negative.
To say the least.
Yeah. The people in the market tests give the actual feedback that this cigarette tastes like poop and it smells like a fart.
The worst product ever.
The only feedback I can imagine being worse than that is, sir, everyone that tried your product has died. I can't imagine a worse consumer feedback than that.
Horrible.
And so Ross Johnson knows Premier isn't going to move the stock, even though they spent hundreds of millions of dollars on it. And then the final straw for Ross Johnson in his attempt to have the public markets recognize his great company actually came in a ruling against tobacco companies. There were several cases in court at the time, and there was one major case in federal court where a widower was suing a bunch of the cigarette companies, saying that it was their marketing and product that killed his wife. Apparently, this guy's case against the tobacco companies, as you can imagine, was pretty strong. And there was a general sentiment that if the damages awarded to this guy were high, then it would just ring the bell for like a ton of other lawsuits to bring down the whole industry, like had happened in asbestos. And this was priced in to a lot of the tobacco company stocks. And so the judge actually rules in favor of the plaintiff, but barely, very small. He only gets a $400,000 settlement, relative to these huge public tobacco companies. And so, Ross Johnson thinks this was a huge monkey lifted off the industry's back and that his stock would finally pop as a result. But of course, it doesn't budge. It doesn't move. This is the last straw for Ross Johnson. Now he's thinking that the public markets are just never going to appreciate my company, is where Ross Johnson is at this point of the story.
Yeah, it's easy to feel bad for him. For all these reasons at this point, Ross is very dejected. This is really when he starts seeing a leverage buyout as maybe the only option left here. You can almost couch a leverage buyout as the logical conclusion of the buyback strategy, right? At the end of the day, if you're doing a leverage buyout, you're effectively buying all the stock back because you think the company is underpriced. And so he's really fixated on this. He's looking at RJR Nabisco, a company that has fantastic food assets, trading purely like a marginal tobacco company, and he's really frustrated. He feels like he's failing at his job as CEO. And there are a lot of great scenes in the book of Ross talking to other executives and to board members of the company, but there's one in particular that summarizes all of them. And it's one in which Ross is talking to this guy, Charles Hugel, who's one of the RJR directors on the board. And he's an old school, buttoned up guy. And Charles is pushing him and he's saying, Ross, why do you want to do an LBO? Like there's so much more still to do with RJR, so much left to build. Why are you so fixated on this being the thing to go do? And Ross tells him that he's having a really hard time being enthusiastic about any of those projects because he can't get the stock price up. And so he's really, really fixated on it. And apparently Charles Hugel thinks that to Charles, proposing an LBO was like shooting someone to rid them of a hangnail. This is how he sort of phrases it, which is a pretty dramatic way to think about it. And he knows Ross and he knows the perks that RJR has. And he also knows that it probably will all go away with an LBO. And this doesn't fit at all with Ross Johnson. So Charles knows this and he's trying to, walk Ross Johnson back. But Ross is still fixated on it. There's another factor in all this, actually, which is probably going to contribute to it. And that's that in September of 1988, Ross Johnson's son got into an accident and he goes into a coma. Hard to know how much this impacted Ross's decision making, but I have to imagine it was a pretty big psychological factor, assuming how he's thinking about things. Ross ultimately calls the CEO of Shearson Lehman, Peter Cohen, and their head of M&A, Tom Hill, who have been running point on all the analysis for RJR Nabisco, including the LBO work, and he gives them the green light. He says, I'm ready to engage. Let's flesh this out. And this is really the point of no return because Ross, Peter, and Tom are going to go forward and explore this in earnest and ultimately come up with a bid. Except they make a couple of critical mistakes here that set up this RJR Nabisco transaction to become the poster child for the LBO boom and all the excesses and all the things of the 80s. Like this is the culmination of everything that the 80s build up into on Wall Street. And the mistakes are these. So the first one is a strategic mistake. The bankers from Shearson Lehman recommend to Ross Johnson that they follow this tried and true plan. It's a 10-week plan where the deal and the financing are structured ahead of presenting a bid to the board. And they call this placing a gun to the board's head because by the time that the management team goes and presents the LBO bid, it's already fully baked. It's on a take it or leave it basis. And the board really has a couple of weeks to react and negotiate and try to maximize value, which doesn't give anyone else, any other potential buyers in the market, any time to react, right? Because anybody else who might be interested in buying the company and competing with the management bid is going to need more than 2 weeks to go put together the financing and submit a bid. And so the idea is that you're basically placing a gun to the board's head with a really fast process. Ross rejects this because he doesn't want to ambush the board. Remember, Ross is all about the politics and managing the board, and he thinks they're on his side, and he doesn't want to rock that boat in case this fails. So maybe he's hedging his bets a little bit. And he also has never played this LBO game before, so he doesn't quite know that all these different plays that he's run in the past in traditional kind of corporate dynamics are not necessarily the place that you run when you're trying to do an LBO and your competition is a bunch of sharks on Wall Street. The second mistake is actually related to this. They, as in, Peter, Tom, and Ross Johnson, they end up convincing themselves that the company's not going to get put in play because they don't think anybody else can do a deal this size, right? Actually, they think only one person can, Henry Kravis, but Ross is absolutely sure that Kravis won't be interested in owning a tobacco company, and so he's not going to be interested in this deal. And boy, is he wrong. The third mistake they make is that Ross doesn't want some finance guy telling him how to run the company or to cut back on his perks. So he demands 20% of the company be set aside for him and the management team, which is a much larger stake than previous LBOs. For comparison, the Beatrice deal that we talked about with Don Kelly had set aside 12.5% for the management team and for Don. And that deal was a quarter of the size of RJR, so a much smaller deal. On top of that, Ross also wants veto power on the board because, again, he doesn't want anybody telling him what to do. Shearson Lehman really wants to be a player in the LBO game. They want to be on the map. They really want to do this deal. Would be the biggest LBO, would really put them in the game. And they know they can't do the deal if Ross doesn't agree. And so they give in and they give him all these things. And this is going to become a PR nightmare. But on paper, it looks amazing for the management team, right? So they go forward with it. So sure enough, Ross takes the bid to the board meeting on Wednesday, October 19th, and lays it all out. They're proposing to take RJR Nabisco private at $75 a share. And the key question is, how does the board react to this? Does it put the whole company at play? What happens? Well, you have to wait until next week to find out.
Oh, cliffhanger. Here we go.
Yeah, this is going to be our first ever cliffhanger. Listeners, if you love or hate cliffhangers, email us feedback to hello@backtestpodcast.com. And as always, thank you for listening. If you enjoyed this, the best way to help us is to share this with anyone you think might like it and to leave us a 5-star rating on Spotify or Apple Podcasts. And of course, to look out for the conclusion of the RJR story next week. See you, Matt.
All right. See ya.